Hello, everyone. I hope you're all having a good day, and thank you for joining us for this webinar. My name is Hannah Taylor, and I'm the managing editor here at Focus Economics, where we provide analysis and consensus forecasts for 198 countries and 35 commodities, both through our monthly economic intelligence reports and online via our Focus Analytics platform. We work with a network of over 1,200 local and global analysts to produce our consensus forecasts for more than 30 key economic indicators. In this webinar, I'll discuss the outlook for the global economy next year. The presentation will cover the outlook for GDP, inflation, monetary policy, exchange rates, and commodity prices. I'll also provide an overview of 6 key economies. First, let's take a look at the GDP outlook. Global growth is forecast to ebb to 1.8% in 2023, down from an estimated 2.9% in 2022. Barring the pandemic-disrupted 2020, this would be the weakest global economic performance since the great financial crisis of the late 2000s. 2023's reading will come on the back of slowdowns in developed economies, emerging Asia, which excludes China, Latin America, and the Middle East, as monetary policy tightens and the impact of the post-pandemic reopening fades. In contrast, sub-Saharan Africa should expand at a broadly similar pace to 2022, while Eastern Europe will return to growth following the expected contraction in 2022 due to the war in Ukraine. There are several key factors to watch. The first is recession in the West. Rate hikes by the Federal Reserve, the European Central Bank, the Bank of England, and others will cause Western economies to slow next year. Our analysts pencil in back-to-back quarterly contractions in the US, the UK, and the Eurozone in coming quarters. While the downturn is currently expected to be mild, if central banks hike more aggressively and for longer than expected in order to tame price pressures, the contraction will intensify. Moreover, while gas storage levels in the euro area are currently elevated, an unusually cold winter in the bloc could still spur gas shortages, weighing on industrial activity. The second factor to watch is the evolution of the Russia-Ukraine war. A quick end to the conflict would likely put downward pressure on global inflation and support sentiment, thus aiding economic activity. In contrast, the conflict could spread to other countries or intensify if Russia uses nuclear weapons. Hitting the nuclear button would risk a large-scale global economic devastation, especially if it resulted in NATO retaliation. Close to two-thirds of analysts that we polled in October did not see the war ending in 2023. Putin seems reluctant to stop the war before a decisive military victory. At the same time, with his army supplied by the West, Ukrainian President Zelensky seems unwilling to entertain peace talks with Russia, while Russia continues to hold Ukrainian territory. The third factor to watch is the health of the Chinese economy. While our current projections are for China to record growth of 4.7% next year, up from an expected 3.2% this year, the country's zero-tolerance COVID-19 stance poses a substantial risk for this forecast. A key unknown is whether the government will shift to a living with COVID strategy. Analysts that we polled in October had divergent views on this subject, with some anticipating such a shift to come in Q1 2023, and others anticipating such a change in 2024 or even beyond. More positively, a raft of measures rolled out in November should support the flagging property sector. A possible Chinese invasion of Taiwan and the emergence of a potent vaccine-resistant COVID-19 strain are additional risks to the global outlook. Now let's turn to inflation. Global inflation is expected to have peaked in Q3 2022 at 9.2% and should decline throughout 2023 amid waning demand, a pullback in commodity prices, and easing supply constraints. By region, inflation is forecast to be the highest next year in the emerging markets of Eastern Europe, the Middle East, Sub-Saharan Africa, and Latin America. Price pressures will come on the back of war-related disruptions, weak currencies, and less effective monetary transmission mechanisms relative to developed economies, which limits the impact of higher interest rates. Inflation in the G7 will be lower than in most regions in 2023, albeit still elevated by historical standards. Effective monetary policy, slowing growth, and government measures to tame energy prices will contain price pressures in the G7. Inflation in Asia, excluding Japan, is forecast to be the lowest of all major world regions next year thanks to relative currency strength, mild domestic demand in China, and Asia's role as the world manufacturing hub aiding the supply of goods. Key risks include additional spillovers from the war in Ukraine, a further reduction in Russian energy flows due to Western sanctions and retaliation from the Kremlin, the level of OPEC oil output, renewed interruptions to Ukrainian agricultural exports if the Russia-Ukraine grain deal falls through, extreme weather events, and labor market tightness. Global interest rates are forecast to end 2023 close to their end 2022 level. Weakening economic activity and easing supply pressures should allow most central banks to end their tightening cycles within the next year. By region, interest rates are expected to be highest in Latin America and Sub-Saharan Africa, and lowest in major advanced economies. Looking at key central banks, the consensus among our analysts is for the Fed's policy rate to peak at slightly below 5% in Q2 2023, while the ECB's rate is seen peaking at a little over 3% in Q3 of next year. In contrast, China's monetary policy is forecast to ease marginally from its current level to support a shaky economy, while the Bank of Japan is set to stick to its policy rate of negative 0.1% next year, the only negative rate among major advanced economies. After reaching multi-decade heights this year due to a hawkish Fed and safe haven demand, the US dollar is seen giving up some ground against other major currencies in 2023. That said, the USD is likely to remain notably stronger than the level that prevailed in the decade leading up to the war in Ukraine. The pace of the Fed's tightening relative to that of other central banks, geopolitical developments, and countries' relative economic prospects will have important bearings on dollar strength. Looking at major currencies, a number of additional risks are present that could stem their expected appreciations against the dollar next year. Regarding the euro, risks include tit-for-tat sanctions with Russia dampening economic prospects, the war in Ukraine spreading to other countries, and persistently higher inflation relative to the US. With the Chinese yuan, the evolution of COVID-19 restrictions, housing downturn, further social unrest, and concerns over the direction of economic policy as Xi Jinping's third term gets underway could all weigh on the currency. Turning to the Japanese yen, a deteriorating export sector as global goods demand fades and activity in the West weakens is a key risk, while the British pound will be vulnerable to market concerns over fiscal policy, potential further political instability, and trade tensions with the European Union. Global commodity prices peaked in Q2 2022 and are seen declining throughout 2023 on softer global demand. However, by Q4 2023, they are still forecast to be slightly above pre-war levels on average due to energy supply constraints stemming from Western sanctions on Russia. Let's dig deeper into a couple of key commodities. Brent crude oil prices are seen averaging above 90 USD per barrel next year, down from the over 100 USD per barrel average expected for this year, but above 2021's average of around 70 US dollars per barrel. While demand is likely to ease on softer economic activity, supply should be tight due to Western sanctions. For instance, an EU oil embargo on Russia will come into force in December. Moreover, OPEC has demonstrated its willingness to support prices if needed, with the cartel cutting output by 2 million barrels per day from November. The outcome of Iranian nuclear talks is a supply risk. While currently unlikely, due to Iranian drone sales to Russia and the government's crackdown on domestic unrest, a nuclear deal would lead to a rebound in Iranian production, pushing down crude prices in the absence of production cuts by OPEC. Other factors that could affect supply include the civil unrest in Iraq and Libya, and a further easing of U.S. sanctions on Venezuela. In fact, some Venezuelan sanction relief has already taken place. In November, the U.S. allowed oil company Chevron to resume operations in Venezuela. Turning to gold, prices are seen averaging around 1,000 USD per troy ounce next year, down slightly from their 2022 average. The global economic and political uncertainty, coupled with the likely eventual softening of the US dollar, will support demand. However, higher interest rates worldwide will act as a counterbalance by reducing the incentive to invest in gold, which doesn't bear any interest. Turning to gold, prices are seen averaging around 1,700 US dollars per troy ounce next year, down slightly from their 2022 average. Global economic and geopolitical uncertainty, coupled with the likely eventual softening of the US dollar, will support demand. However, higher interest rates worldwide will act as a counterbalance by reducing the incentive to invest in gold, which doesn't bear any interest. Finally, let's take a brief look at the outlook for key global economies. We'll start with Brazil. Monthly economic activity data suggests the economy recorded brisk growth in the third quarter, aided by the services sector. However, the economy is likely to lose momentum in Q4 amid slower momentum abroad, political uncertainty linked to the election, and lower prices for key commodity exports. Next year, growth is seen slowing to a mere 0.8% as the boost from the pandemic reopening fades and commodity export prices fall further. A key risk is the direction of fiscal policy under Lula, given his promise to boost social spending and the country's large fiscal deficit and high level of public debt. Tensions between the Lula administration and Bolsonaro and his supporters are a further risk. Turning to China, economic activity is currently limp. While GDP growth accelerated in Q3, it was still far below pre-pandemic levels, and a raft of economic indicators, including retail sales, industrial production, and investment, all undershot market expectations in October. With the country currently seeing record COVID-19 cases and tighter restrictions through November, the outlook for Q4 is downbeat. Turning to 2023, our current consensus is for GDP growth to recover to 4.7%, although much hinges on the effectiveness of recent measures to support the housing sector and the duration of the zero tolerance pandemic approach. Regarding the latter, there are signs that the end of zero COVID could be near. Following the worst protests in decades, several Chinese cities rolled back restrictions at the end of November, and a top government official suggested that the pandemic could be entering a new phase. Turning to the euro area, quarter-on-quarter GDP growth decelerated in Q3, although it surprised markets on the upside. The slowdown came amid higher inflation, energy prices, and interest rates. The economy will likely shrink in quarterly terms in Q4 as the ECB continues to ratchet up interest rates and price pressures intensify further. In 2023, activity is seen flatlining in annual terms. Gas shortages are a risk, although high levels of gas storage have reduced the chances of this in the short term. Further sanctions on Russia, as the EU currently prepares its ninth sanctions package, the widening of the war in Ukraine, the path of interest rates, and additional EU-wide and country-specific fiscal support are all factors to keep an eye on in the next year. Regarding India, PMI data for both the manufacturing and services sectors suggests that the economy is expanding at a brisk pace as 2022 nears its close. Looking to 2023, India is seen expanding 5.9% at one of the fastest rates in Asia, thanks to strong gains in private consumption and fixed investment. The government's Production Linked Incentive, or PLI scheme, which aims to boost domestic manufacturing capability, will be important to watch. The scheme has reportedly already attracted investment worth around $29 billion by the end of March 2022. Further free trade agreements are another area to keep an eye on, as an FTA with Australia was approved by that country's parliament in November, while talks with the UK and the GCC grouping of Arab nations are currently underway. Looking at Russia, the war in Ukraine dragged the economy into recession as GDP contracted again in Q3. Domestic demand was hurt by international sanctions, while the external sector likely felt the pinch of Europe's shrinking demand for Russian hydrocarbons. Turning to Q4, a bleak geopolitical environment continues to weigh on the economic landscape. Looking to 2023, the economy is seen contracting 3.1% as exports to the West decline further. Key risks include the outcome of the war in Ukraine, further Western sanctions, and a potential broadening of domestic unrest, which could occur if conscription is widened, the country struggles on the battlefield, and the economy nosedives. Finally, the U.S. economy returned to sequential growth in Q3 following two consecutive quarterly contractions. Turning to Q4, activity is seen losing steam amid an expected downturn in exports and softer government spending growth. However, available data suggests resilient household spending. In October, retail sales jumped while job gains beat market expectations. The economy is seen stalling in 2023 as interest rate hikes and a downturn abroad weigh on the economy. That said, strong energy exports will continue to provide support. Faster than expected Fed tightening is the key downside risk. Potential difficulty raising the federal debt limit and heightened tensions with China also cloud the outlook. This brings us to the end of the webinar. I just wanted to wrap up with our bottom line for the global economy. First, global economic activity will slow sharply next year. Second, inflation will decline but remain above pre-pandemic levels. Third, the monetary tightening cycle will peak. Fourth, the US dollar should weaken. And finally, commodity prices will trend down in 2023, but end the year slightly above the levels that prevailed before the war in Ukraine began. Thank you for listening, and I hope you've enjoyed this webinar. I've been Hannah Taylor, Managing Editor at Focus Economics, and I hope you have a great rest of your day.